Microsoft, one of the best big tech companies in the world, just reported earnings and went up another 8.28% after hours. This is after the company has already been up 22% year to date and a 44% recovery from April lows. Why did this happen? Well, Microsoft beat on both revenue and earnings per share expectations for their Q4 2025 earnings. And today I'm going to give a full summary of that earnings report, exactly why the stock popped so much. I'll give you a hint. It has to do with their cloud business, Microsoft Azure. And I'll give you another hint. It has a lot to do with AI accelerating the growth of that business to truly impressive levels. If you don't know, Microsoft is a stock we cover a lot on this channel, and it's actually the #1 position in my long-term dividend growth stock portfolio. It is 24% of that account by total value, which is only going to go up now. And I plan on this being a core position well into the future. So today I'm going to give you an updated stock analysis on Microsoft and explain why it's a company you want to buy and hold for decades to come. That will include an overall look at their stock performance and key business financials, plus a deep dive into their latest quarterly report that sent the stock soaring. With that said, let's roll the intro and get into this Microsoft stock analysis. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I will be using the best stock research tool, dividenddata.com. The link is in the description and pinned comment of the video. So let's start with the earnings. As you can see, their non-GAAP earnings per share for the quarter came in at $3.65, which is an all-time high for Microsoft, and it continues this trajectory of high earnings growth. And over the long term, the stock price and valuation of a company should follow the earning power of their business. Growing earnings also increases the capacity of a company to increase their dividend payment. Microsoft is an incredibly reliable dividend growth stock with a 10-year compound annual growth rate of 10.35%. They increase it basically every single year, 10% like clockwork. This is very sustainable too, with a free cash flow payout ratio of 29% and net income payout ratio of 24%. The company also reliably buys back stock. However, Microsoft very much is a growth business, and they have a lot of opportunities to reinvest into their core businesses, and they do make acquisitions along the way. Speaking of expectations for that growth, analysts are projecting double-digit earnings per share growth every single year, all the way through 2029. And most of those years are as high as 17%. Now let's go dive into that latest quarterly report, and we'll start to explain what are those key growth drivers for Microsoft's business. So as you can see, they just reported earnings after market close, and Microsoft stock came in at $76.4 billion of revenue, which was 3.6% ahead of analyst expectations for revenue. And the $3.65 for earnings per share were 8.31% ahead of analyst expectations, which is a huge beat. And again, Microsoft stock is up over 8% after hours. But it actually has a lot more to do with what they said and what business segments they reported high growth in. After I saw the news, I went and looked at the AI analyst over on dividenddata.com and asked it to summarize the latest quarter and earnings call for Microsoft. You can do this for any stock, and it's sourced from real financial documents and verified financial data. And this is where it starts to get interesting. Let's start with a look at that year-over-year growth. Revenue for the quarter grew 18% year over year, which is fantastic growth for a large company like Microsoft. Operating income grew 23% year over year with $34.3 billion in the quarter. Net income came in at $27.2 billion, up 24% year over year. And diluted earnings per share for the quarter was up 24% year over year. But the real story is here in their business segments. Microsoft Cloud, which includes Azure, their biggest growth business. I'll be talking a lot about that. It also includes Microsoft 365 and Dynamics 365. That revenue altogether, which is their cloud revenue, came in at $46.7 billion, which is up 27% year over year. Microsoft Cloud is the core growth business of Microsoft. And of that segment, Microsoft Azure is the king. Revenue for Azure grew 39% year over year. That is an acceleration and much higher than Google Cloud's growth and Amazon Web Services growth. that was significantly ahead of analyst expectations. They not only saw accelerated AI infrastructure growth, but they saw accelerated growth in all of their core infrastructure business. If you don't know Microsoft Azure, this is basically a cloud hosting company. It's one of the largest in the world. It's second in scale to Amazon Web Services, and it's much larger than Google Cloud, which is currently in third place. And you can do things like host applications, databases, and usage of AI models with AI inference has become an increasingly large business for these cloud providers. And Microsoft has actually been leading the pack here thanks to their early investment in OpenAI, where they are a significant owner and for a while had an exclusive partnership to be their cloud hosting partner. The main story with Microsoft is this cloud growth. And speaking of that, the CEO Satya Nadella gave a big update to the size of that Azure business, which is rarely actually reported. Since they just finished their fiscal year 2025, they announced that Azure surpassed $75 billion in revenue for this year. So that means that Microsoft Azure is now over 26% of their total revenue. And that business is growing 39% year over year. So what that means is every single year, this is becoming a larger and larger part of Microsoft's business, and it is growing at a high rate. That means as Microsoft Azure becomes larger, Microsoft as a whole will financially actually be accelerating in growth. So I'm going to put together a really simple model here in Excel of what this kind of growth could look like if they continue growing at 39% a year. By next year, that would be over $104 billion of revenue. By 2028, that would be over $200 billion of revenue. And by 2030, that would be $389 billion of revenue. Now, I know 39% is very aggressive, but that just shows how much these growth rates matter because the compounding is insane. For context, that $389 billion of revenue, that is more than all of Microsoft's revenue together, including the rest of their cloud business with their Microsoft 365 bundle, and their gigantic gaming business after acquiring Activision Blizzard, and all of their legacy cloud services, and their personal computing segment. Oh, and let's not forget the licensing of Windows as well, which was their original business. All of those businesses will likely grow as well. And even if Microsoft just grows at 30% a year in Azure, which is very realistic and was kind of where the expectations more were at already, they'd be at nearly $100 billion next year. And by 2029, they'd be at $214 billion. And at 2030, $278 billion. So again, that's already fantastic growth for that business. But it also brings up a very important point about how these different growth rates impact long-term compounding. If Microsoft growth stays at this high accelerated level or actually increases even more, then the compounding would be absurd. 39% growth versus 30% growth. By 2030, that's a difference of well over $100 billion. And Microsoft Azure is not going to be done growing then. And as we go back and look at Microsoft stock, it underscores why growth is one of the most important factors to look at when you're investing. I'm talking about growth of the actual financials of the business. It can be difficult to accurately forecast, but you can't forget it altogether. Before going up over 8%, you were paying nearly 40 times last year's earnings for Microsoft stock, but the company continues to grow. So as you can see here on dividenddata.com, we have the future earnings estimates table, which takes analyst estimates for future year earnings per share. And if we have 13% growth next year, that would mean you were buying the stock at a forward PE of 33. And if they hit these growth metrics through 2029, you would be paying for Microsoft at a 21 PE ratio based on 2029 earnings. But again, Microsoft's not done growing then. The company will keep growing well beyond that. And the reason why the stock is up is the latest earnings report signaled that analysts should probably be raising these expectations for future earnings per share at Microsoft and for revenue growth as well. And one final note before I wrap up this Microsoft stock review video, I want to talk a little bit about CapEx at Microsoft. This is something I mentioned in my Google stock analysis video after earnings when they raised their CapEx guidance. And that's because these AI companies are spending big on infrastructure. And that's because they have massive growth to invest into. This quarter, they had $24.2 billion of CapEx. And for Q1 2026, they are forecasting $30 billion. And that is driven by continued strong demand signals. And based on what they just reported, they definitely have the demand for this investment. However, they did say that in fiscal year 2026, they expect the growth rate of their CapEx to moderate compared to fiscal year 2025. And this is important because the growth of CapEx at companies like Microsoft has been insane. As you can see, this has been ramping up significantly, which has been eating into their free cash flow. So although the company is growing revenue and earnings, their free cash flow growth has actually been pretty mild. That's because they're spending so much more money. But in my opinion, the results are there and it's well worth it right now. Microsoft is a core position of my long-term dividend growth stock portfolio. And I knew after making this earnings report, I had to make an emergency video for you guys. So I hope you enjoyed it. Make sure to leave a like, comment, and subscribe to the channel if you enjoyed. And stay tuned for future portfolio updates and stock analysis content. If you want to use the tool I showed throughout, it's all available at dividenddata.com. The link is in the description and pinned comment of the video. With that said, thanks for watching and I'll see you in the next one.